Ever wondered how to magnify your investment returns without magnifying your initial investment? Welcome to the intriguing world of call options, a powerhouse tool in the financial markets that can potentially amplify your investment outcomes. Imagine having the ability to control a large amount of stock for a fraction of what it would cost to own it outright. That's exactly what call options offer. They provide you the right, though not the obligation, to purchase a stock at a predetermined price, known as the strike price, within a specific time frame. This right can be a game changer. For example, if you believe a stock's price is going to rise, buying a call option allows you to lock in a purchase price now without the hefty upfront cost of buying the stock directly. If the stock price climbs above your strike price, your option increases in value, giving you the opportunity to secure profits at a relatively low cost. That's the magic of call options, leveraging opportunity with controlled risk. But what exactly is a call option, and how does it function? Imagine you're eyeing tickets for a highly anticipated concert. You're not sure if you can make it, but you want to secure the option to attend. So you pay a small fee to reserve a ticket at today's price, regardless of whether the ticket price increases later. This fee doesn't buy you the ticket itself, it merely gives you the right to purchase it later at the agreed price. This scenario closely mirrors the essence of a call option in the financial world. A call option is a financial contract that gives the buyer the right, but not the obligation, to buy a specific amount of an underlying asset, like stocks, at a predetermined price, known as the strike price, within a set time frame, until the expiration date. The buyer pays a cost called the premium to the seller of the option. Let's break this down further. Firstly, the underlying asset is what the option is based on, such as shares of a company. If you believe the company's stock is going to rise, purchasing a call option allows you to capitalize on this potential increase without initially buying the stock. Secondly, the strike price is the fixed price at which you can buy the stock if you decide to exercise the option. Think of this as the concert ticket's face value. Thirdly, the premium is the price you pay upfront for the call option. This is like the reservation fee for the concert ticket. It's non-refundable, and its size depends on various factors, including how long until the option expires. Finally, the expiration date is the cutoff point for your right to buy the stock at the strike price. After this date, the option becomes worthless if not exercised. It's akin to a concert date. After it passes, your reservation loses its value. Think of it as reserving the right to buy a stock at today's price, betting it will rise tomorrow. Now, how do you measure the potential and the peril in a call option? Let's dive into the world of premiums, volatility, and time to expiration to unravel the true cost and benefits of a call option. The premium is the price you pay to acquire a call option. It's not plucked from thin air, but is intricately calculated based on several key factors. One of the prime influences is volatility. High volatility in the underlying stock means higher premiums. Why? Because the more a stock price fluctuates, the greater the chance it will hit or surpass the strike price, potentially leading to a profitable outcome for the holder of the call option. Another critical factor is the time until expiration. Options are like milk. They have an expiration date. The more time an option has before it expires, the more valuable it is. This is because there's more time for the stock to move above the strike price, increasing the chances of a profitable exercise. Speaking of strike prices, the relationship between the stock's current price and the strike price cannot be ignored. If the current price is already near or above the strike price, the premium tends to be higher because the likelihood of a profitable exercise is greater. Now, let's talk about the break-even point. This is where the stock price must reach, at expiration, for the option buyer to recover the premium paid. It's calculated simply, the strike price plus the premium paid. This point is crucial for understanding if diving into a call option is worth the plunge. It's all about striking the right balance between risk and reward. How do savvy investors use call options to their advantage? Call options are not just about making direct profits. They are a versatile tool in the savvy investor's toolkit. One of the primary strategic uses of call options is hedging. Imagine you own shares of a booming tech company, but are concerned about potential short-term dips in the stock market. By purchasing call options, you can potentially offset losses in your stock holdings, with gains from the options if the stock price falls. This method acts as a safety net, allowing investors to maintain their positions in the stock while mitigating risk. Another compelling strategy is speculation with reduced capital outlay. Instead of purchasing a stock outright, buying a call option allows investors to control the same amount of stock with significantly less money. This is particularly attractive in scenarios where capital is limited, but the potential for growth is high. For instance, if you're bullish on a company's prospects but don't want to commit a large amount of capital, you can use call options to speculate on the stock's future rise. Furthermore, call options can generate income through what is known as call writing. Here, an investor sells call options on stocks they already own. This strategy provides the investor with premium income from the options sale, which can be a consistent revenue stream, especially in a flat or mildly rising market. With strategic application, call options can not only protect but also significantly enhance your investment portfolio. Let's put theory into practice with some real-world examples. Imagine an investor, Alex, who's been closely monitoring the tech industry. Alex anticipates that a certain tech company, let's call it Tech Advance, is on the brink of announcing a revolutionary new smartphone. Believing in the potential market disruption, Alex buys call options for Tech Advance shares at $50 per share. A month later, Tech Advance unveils its innovative smartphone with features that outpace any current models on the market. The stock, as expected, skyrockets. It climbs from $50 to $80 per share shortly after the announcement. Alex exercises his call options, purchasing shares at the much lower agreed-upon price, and then sells them at the current market rate. The result? A substantial profit from a well-timed call option investment. This scenario isn't just a stroke of luck. It's a strategic move using call options to capitalize on predicted market movements. These examples show how call options can turn predictions into profits. Before you dive in, what should you remember and watch out for? Call options are a powerful tool for investors looking to leverage their capital, offering the potential for significant returns on a relatively small investment. Remember, the allure of high reward is indeed tempting, but it comes with its own set of risks. The most glaring of these is the possibility of losing the entire premium paid if the market does not move in your favor. It's crucial to understand that while the upfront cost of purchasing a call option is lower compared to buying the stock outright, this premium is non-refundable. This means if the option expires out of the money, the investment is lost. Therefore, evaluating the risk versus reward is paramount. Ensure you conduct thorough research and market analysis before entering into any options contract. Assessing historical price movements, market conditions, and economic indicators can guide your decision-making process. Armed with knowledge and caution, you're now better prepared to explore the dynamic world of call options.